If you're looking for a step-by-step system on how you can create a new stream of income by investing in REITs, you are in the right place, because in this video, I'm going to go over three things. Number one, we're going to break down the difference between investing in REITs versus investing in physical real estate. Then number two, I'm going to go over different types of REITs that you can consider investing in with specific examples. And then number three, we're going to put it in action. We're going to talk about how do you actually invest in REITs with a plan. So with that, let's jump right in and let's start by talking about the difference between REITs and real estate. You want to invest in real estate. Great. Now there's a couple of ways that you can go about doing it. You can go out and create your own company. You can create an LLC that can then go out and invest in real estate like this. Now you can go out and raise money from debt. You can go out and raise money from investors, or you can have cash in the bank and you can use your cash to go out and buy this property. Now when you buy this property, the goal is to generate rental income, because now people are going to live in here, or businesses are going to use the space, and then they're going to pay you rent in exchange for using or living in your property. But when you own the property yourself, you now have to operate and manage the property. You can hire property managers, but you still got to oversee the property managers. You got to make sure the bills get paid. You got to make sure the taxes get paid, and you got to make sure that the property is leased out. Because if the property manager is not doing the job, it's up to you as the owner of this company, as a creator of this company, as a manager of this company, to fire the property manager and get a better property manager in there. Of course, it comes with benefits, because now you own this, so you can choose how to operate it. You can decide what type of landscaping you want to put on this property. You can decide how much you want to charge for rents. You can be as involved as you want, but it's still up to you to now take care of those decisions. And as the operator, as the owner, you get your own tax write-offs. You get your own benefits with there as well. But the alternative is, instead of you now going out and creating this company, you can go out and invest in this real estate company. Now, when you invest your money into this real estate company, you don't actually own the real estate itself. You own a piece of the company that owns the real estate. This is what a REIT is. A REIT is a real estate investment trust. And the way REIT investing works is, now you are investing in the company that's investing in the real estate. And the reason why some people like investing in REITs is because now you can get that exposure to real estate. You can get the cash flow from real estate without having to actually own the physical real estate, without having to deal with the headache of owning real estate. What does that mean? REITs have to follow what's called the 90% rule. And the 90% rule says that REITs are required by law to distribute at least 90% of their taxable income, essentially their profits, to their shareholders in the form of dividends. That's why generally REITs pay out higher dividends, because, well, they're required by law to pay out at least 90% of the taxable income to shareholders, to their investors, in the form of a dividend. Again, a dividend is a cash payment that a company gives you for doing nothing except owning that stock. Now, another advantage of owning REITs today, at the time of recording this video, is that there are certain tax advantages through REITs. What do I mean? When the Tax Cuts and Jobs Act was passed, one of the provisions in there was to give investors in REITs a 20% deduction on the income that you generate. That means if you make $10,000 in 1 year by investing in a REIT, you can take a 20% write-off against that deduction, because the taxes with REITs can be a little bit different, and sometimes you don't qualify for the long-term capital gains tax rates, meaning the lower tax rates with REITs. This was an incentive put in to make people more attracted to investing into REITs. However, just for full transparency, this is currently set to expire in the end of 2025, when the Tax Cuts and Jobs Act is also scheduled to expire. Will it be renewed? We don't know. We'll see what happens later, but that's what we know as of today. But the main thing that I want you to understand here is that when you invest in a REIT, you're not getting direct exposure to the property. You're getting ownership into the company which owns the property. That's the difference between you investing in a REIT versus you owning the property. When you own the property, you're buying the asset. Here you're buying the company, which is buying the asset. Now that we laid the foundation of what a REIT is, let's talk about the different kinds of REITs, because not all REITs are created equally. The two largest categories of REITs, and the two types of REITs that I'm going to highlight in this video, are equity REITs and mortgage REITs. Equity REITs are REITs, which are real estate investment trusts, real estate companies that invest in income-producing real estate. Mortgage REITs are real estate investment trusts, real estate companies that don't invest in the physical properties. They're investing in the mortgages or the mortgage-backed securities that are going into those properties. So here you're getting exposure to the debt. Here you're getting exposure to the actual property. Now I gotta give you the disclaimer before I give you some specific examples of this, which is I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. And all the examples that I give you are just for example purposes. I'm not telling you what to invest in. Here are a few different types of equity REITs that you can consider starting your research on. Number one is Realty Income Corp, which has a ticker symbol O, and currently at the time we recorded this video, this has paying out a dividend yield of 5% a year. This is a REIT which invests in commercial properties around the world, income producing commercial properties. Then you have Crown Castle Inc., which has the ticker symbol CCI, currently paying out a yield of around 5.6% a year. This one invests in cell phone towers and other data infrastructure like fiber that can help supply technology, data, and other IT services around the United States. Then you have Invitation Homes with the ticker symbol INVH, currently paying out a yield of 3% a year. This is a REIT that invests in single-family homes for rental purposes, and then it also manages the leasing of those single-family homes, currently paying out a yield of around 3% a year. Again, all of these are equity REITs, meaning these are investing in the physical properties and looking to get the income out of those properties, the rental income out of those properties. This is where if you're thinking about investing in individual companies or individual REITs, you have to be able to analyze these companies. That means you have to be able to read a financial statement. You have to be able to listen to earnings calls. You have to be able to analyze these companies and value these companies to see if it's a good investment for you. Some of you are going to say, yes, I love that idea. That's what I want to do. No problem. Others of you are going to say, I don't want to do that. Is there a way for me to just get broad exposure to REITs? And this is where you can look for something like an ETF. An ETF is an exchange traded fund. It is a group of companies. And so now you can look for ETFs that give you exposure to equity REITs. An example is VNQ. This was an equity REIT ETF created by Vanguard, which invests in REITs that are investing in income producing properties. That means if you invest in this ticker symbol, VNQ, you're going to be investing in a small piece of a number of different equity REITs. So if you invest in one fund like this, now you're owning a basket of equity REITs, and at the time of recording this video, it's paying out a 3.5% yield. Now, let's switch gears a little bit and talk about mortgage REITs, and you'll see why they're a little bit different. Now, of course, if you are an investor and you want to stay up to date on what's happening in the financial markets, this is where you want to join something like Market Briefs. Market Briefs is a free financial newsletter where every day my team is breaking down what's happening in things like stocks, the housing market, the economy, the crypto market, and the global economy into a fun, reading, and easy to read newsletter. You can read in less than 5 minutes every morning, and it's completely free. We have over 250,000 investors reading Market Briefs every day. So if you have not joined Market Briefs yet, I got the link for you to join down in the description below. Investing in mortgage REITs is generally more risky and more volatile than investing in equity REITs, and because of that, you'll generally see higher dividends on these types of mortgage REITs. Now, before you go out and make an investment decision based solely off of the dividend yield, you got to remember and understand that you're investing in the underlying asset, not just this dividend, because just because you get a high dividend doesn't make it a great investment if the value of investment is going down. And so this is where you want to make sure you do your own due diligence and understand higher risk, higher reward. You'll see much more volatility with mortgage REITs than you generally will with equity REITs. And so you got to find what's right for you. But a couple examples here are Annaly NLY. The ticker symbol is NLY. Annaly Capital Management, which is currently paying out a yield of around 13%. And this is a company that invests in mortgage-backed securities. Now, mortgage-backed securities are a complex financial instrument. They are a financial derivative, which is one of the reasons why they can be very volatile and very risky. Another example is AGNC Investment Corp, which at the time of recording this video is also paying around a 13% yield. This is investing in mortgage securities, mortgage derivatives, different mortgages that are backed by single-family homes. But again, more risky, higher potential returns, but also higher risk. Now you might be wondering, well, Jaspreet, are there any funds for these types of mortgage REITs? Yes, there are a number of them out there. One example is REM. This is an ETF created by an institution called iShares. This invests in mortgage REITs. So if you invest in REM, you're getting exposure to mortgage REITs, a number of different mortgage REIT companies. At the time of recording this video, it's paying out a 9% dividend yield. Again, you're lowering some of your risk by investing in a fund, But again, mortgage REITs are generally more risky than investing in equity REITs. Now that we've laid the foundation of what a REIT is versus investing in real estate and the different kinds of REITs, mortgage REITs and equity REITs with specific examples of them, let's talk about how do you actually put it in action? How do you actually invest in these REITs and see the highest success? Now, the way you invest in a REIT is similar to how you invest in other stocks with one little difference. When you invest in stocks, you can follow more of an active or a passive strategy. An active strategy is what many people call fundamental investing. This is where you're looking for the individual company and then you make an investment when you see a good opportunity. Passive investing is what some people like to call dollar cost averaging, where now you're going to make an investment every week, every 2 weeks, every month, and you're going to set it and forget it. That way it is a reoccurring investment and you don't have to worry about it. Now, the thing about REITs that makes them very unique is people like to invest in REITs because of the dividends more than anything else, because that's why people invest in real estate, is you want the income. And so in order to make REIT investing successful, you have to understand what you want to do with these dividends as well, which means you also have to think about taxes. Because when you make an income through your real estate investments here in the stock market, you have to pay taxes. So if you now make this income from your stocks and you reinvest that money, you still got to pay taxes. So you want to think about now something called DRIP, DRIP. This is called a dividend reinvestment program, where now when you make your money from dividends, what do you want to do with it? If you want to reinvest it, that means as you make your money from dividends, that money goes back into your investment, back into your stock, which is hopefully going to pay you more dividends in the future. But as you make this money, you still have to pay taxes. Even if you never see this money because it's automatically reinvested, you still have to think about taxes. And this is one of the big differences between investing in a REIT versus investing in physical real estate, because when you invest in physical real estate, you get different types of tax breaks on the income that you get. Because when you get income from owning the property, you get to file what's called depreciation, which allows you to make the money and pay less money in taxes legally. With this, when you get your dividends from a REIT, you don't get that. Now, through the end of 2025, you still get that 20% deduction on the income that you get from REITs. We'll see what happens if that gets extended or not. But this is where you want to think about what you're going to do with those taxes. But now, if you want to succeed as an investor, the key here is to, number one, be able to analyze the investments, and then number two, stay consistent with their investments. Most people are not going to have enough money to just dump into this investment one time and then have enough income to live off of this investment for the rest of their life. You're going to have to make consistent investments, which means you might need to make more investments every week or every 2 weeks or every month. Every time you get paid, that way you can continually build your income. That's where the real wealth is built. It's through, number one, making money, investing it. Number two, making more money, investing more money. Number three, investing consistently. And then number four, as you make that money, drip it back in. That way you can continue to keep reinvesting your money. That's how you build your wealth. It's not by just dumping a couple $1,000s in there today and then hoping that the couple $1,000s is going to make you a millionaire tomorrow. That's not how it works. It's that steady, consistent investment again and again while the markets are up and down, because guess what? We know that real estate goes up and down. We have seen real estate crashes before. We all remember 2008, 2009, 2010, 2011, 2012. That was a very tough period for real estate if you owned real estate, but it was a great time to be buying. And so this is where understanding that real estate goes through cycles, the stock market goes through cycles, and as a financially savvy investor, you want to be able to find the opportunities even when people are running away, because we know the markets go up and markets go down. Housing prices go up, housing prices go down. Stocks go up, stocks go down. And if you are a long-term investor, you can find the best opportunities. When most people think of generational wealth, they're thinking, I own this home that's worth $600,000 with a $500,000 mortgage. Then I'm going to work to pay down my mortgage to $0. That way then I can pass down this house to my kids. But that's not what real generational wealth looks like. Real generational wealth looks more like this.